naira. I think we have done justice to that. Now, let's move to question number 7. Number 7 question said, purchase goods on cash from Tunji 100 naira on November. You know the hint I gave you the other time that anything that was sold on cash, it is that cash and the goods that was purchased and purchased or sold is what you will consider, not the name. But if it is on credit basis, then you recognize the name of the person that make the sales or purchase the transaction on credit. So now this is on cash. So the first thing you have to recognize is cash account and purchase account. How much is it from 200 naira? So cash purchase account, you know, when you purchase, this is the ledger. When you purchase, that goods comes to you, so you receive. So that means we have November 21 cash. How much? 100 naira. Then you prepare cash account. Don't forget debit and credit. Then cash goes out. You purchase, when you purchase something, you receive that thing and you give cash. So cash goes out, which is November, on November 22, you purchase. And that is 100 naira. Then number 8 question says, paid wages 20 naira cash on November 22. Wages, the two accounts that you are going to consider here, the two accounts that is involved is wages and through what? Is it on check or cash? It is paid on what? With cash. These are the two items that you are going to consider. Now, when we prepare wages account, you know, when you receive wages, it has to be debited. That means you are the receiver and you receive cash as wages on November 22. How much is 20 naira? Then you prepare wages account as well. So sorry, you prepare cash account. That means money goes out to pay wages. November 22, we have wages, which is 20 naira. Then we move to example 9, which says goods returned to us by Yemi 70 naira on November 22. I told you the other time that accounting has to do with interpretation. What the interpretation account determines whether you are on the right side or the wrong side. So accounting has to do with interpretation. When you are given a statement, it gives you ways to interpret it. Now, goods returned to us by Yemi 70 naira. When goods is returned to us, we call it return inwards. The first account you prepare is return inward account. When goods is returned to you, we call it return inward. But when you return goods to someone, those goods that you bought that they are not good, they are bad. When you return it to other person, you call it return outward. But when somebody return goods to you, when a customer that already bought goods from you return that goods, that means those goods are not good or they are spoiled or bad. So we call it return inward. So when goods are returned to us by Yemi, then the first account that you prepare is a return inward account. Then you now prepare Yemi that return the goods. Now, return inwards. You know, when money is returned, when when goods is returned to you, you receive it. So the application you are using on does not change. The same application we use at double entry, that is also what we use here. When somebody returns goods to you, you receive that goods. So when you receive, it has to be debited. November 22 through Yemi amounted to 17 naira. Then you prepare Yemi's account because it is Yemi that returned that goods. So you credit the account of Yemi because the goods goes out of Yemi's account. November 22, return inward, which is 70 naira. Now the last but not the least, which is number 10, we return goods to Joy. When you return goods, you call it return outward. The first thing you have to prepare is return outward account. Then you prepare Joy account. And I told you, return inward. The same applications you are still going to use, return outward. You send goods out. That means you are giving it out. So, and when you give something out, it has to be credited. That means this is November 23. You write Joy. How much? 70 naira. Then you prepare Joy account. Who is receiving it? Which is November 23. Return outward. How much is it? It is 70 naira. So those are the illustrations. We have many illustrations as touching single entries using the same application we use on this illustration. We've treated the double entry principles. Now, under the themes, we'll be talking about accounting concepts. What is the meaning of accounting concept? Accounting concepts are the rules of accounting that should be followed in the preparation of all account and financial statement. And this concept we are talking about is issued by Nigerian Accounting Standard Board. And in other words, accounting concept, you know, as an accountant, there is accountant is subjected under concept, procedures, basis, and methods. So, and this is given to accountant in order to ensure uniformity in preparing a financial statement. So, two different accounts, they are put under the subjection of accounting concept. That's why it is rules that every accountant should follow in order to ensure uniformity in preparing financial statement and dealing with their clients. What are the accounting concepts? We have different accounting concepts. The first one is entity concept. What is the entity concept? This concept, entity concept, states that every economic unit, regardless of its legal form of existence, is treated as a separate entity in accounting from party having economic interest in it. To buttress my point, entity concept is that in as much a company has been registered, it is separated from the person that has economic interest in it, and it becomes a legal entity on its own. That means the company can be sued, and the company can also sue a person. So in as much a company is registered, it becomes entity concept. Now, the second one is going concern. This assumption is that the business unit will operate in perpetuity That is, the business is not expected to be liquidated in the foreseeable future. When a company is being established, there is an assumption that the company will not fold up in the foreseeable future. That is, the company will not cut the line of the business. Maybe they are dealing with 3 types of business. In foreseeable future, the company is not likely to cut one of the line of their activity. So going concern ensures that the company must operate in perpetuality. That means there is not any threat that is likely to happen. So that is that for going concern. Then we'll be talking about prudency concept. Under this concept, this principle demands exercise great care in the recognitions of profit while all known laws are adequately provided for. As an accountant, under this accounting concept, which is prudency concept, ensures that accountants must be very careful when discovering or realizing profit. And there are some losses that used to affect the profit, which accountants in their preparation must make provisions for. And under the concept, we have examples like that, like provision for bad debt. The company, an accountant preparing the statement must make a provision for that loss, so that it will not affect the profit of the organization.